How to invest $50 million. The $50 million question. Right now, let's get to it. I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and the Tatro Wealth Advisor Group. $50 million, it's a lot of money, but how do you actually invest it? What do you do? How do you actually build a portfolio for that? How do you protect your wealth, be tax efficient, make sure that the money that you're generating is going to be there for the next generations? How do you manage for philanthropy? How do you manage for insurance? How do you do all of that if you got $50 million? Okay, let's get into it right now. If you'd like to book a no obligation consultation to chat about this or anything else on your mind, please go to www.speaktorob.com. We'd love to book a chat with you about this or anything else. All right, $50 million annually. If you're generating 10%, is going to generate 1/10 of that, which is $5 million annually of income. So no matter what, you're going to have a significant tax problem the rest of your life. You can get trusts. You can try to, divide your income among your beneficiaries. You can try to divide your income in different trusts and different corporations. But when you're at the $50 million mark, you're going to be top tax bracket for the rest of your life. It's a good problem to have, as my dad used to always say. The tax that you're going to be paying on the $50 million, call it 50%, right? So we want to make sure that the investments that we are buying, that we are building for you, are extremely tax efficient, okay? So first of all, how do we do that? So we want to focus on stuff that's got either deferred capital gains or that is going to pay what's called return of capital. An easy way to do that is through private real estate or anything that doesn't pay either a fixed dividend or that doesn't pay income. So the trade-off here is that you're going to want to have a portion of your wealth that's likely paying something fixed, okay? But you're also going to want to have a big portion of your wealth that is, tied to the stock market. So most of the endowment funds and the institutions and the pensions that are at the $50 million mark do not have a traditional balanced stock portfolio, right? So the 60-40, 60% stocks, 40% fixed income, that's not what they own. Okay. Most of them have a combination of stocks, which acts as kind of their catalyst, their alpha. They hope to make 10, 12, 15% in there, some small caps, some emerging markets, etc. But they also have a lot of private uncorrelated assets. So that will typically be infrastructure, typically be real estate, could also be stuff like farmland, music royalties, investments that do not have a correlation to market. Private equity is also a big one. So you got $50 million. Let's talk about the portfolio strategy first and foremost. So yeah, I could tell you till the cows come home to buy the tech large caps and the large cap financials. That's great, but really what percentage should it be? So you should have a strong focus on US and global companies for a majority of the portion of your stocks that are going to be in equities. You should also have a portion of your portfolio invested in non-correlated assets. Okay, so a portion of that needs to be, in my mind, real estate and infrastructure. Why? Because if the stock market moves down 20%, or 30% or 40%, those investments are not going to drop. They are uncorrelated to the market. And a lot of times they have reverse correlations to the market. Back in the day, we used to use fixed income for this. Bonds, traditional bonds. Well, why would we consider using bonds for a $50 million portfolio when they're yielding, 1% taxable? So if you have 1% taxable, in your mind, if you own a 5-year bond yielding 1%, you know that for the next 5 years, your best case scenario is 1% pre-tax. You're going to lose half of the income to tax. You're left with 50 basis points. It's not enough to buy you lunch and groceries, right? So we want to make sure that the portfolio we're structuring has that stability in it that used to be generated by fixed income. And we want to make sure it's got the growth in it that is typically generated by stocks. So you need to have both of those. And if you got $50 million, there's no way you're going to spend all of the income annually. Maybe you got a couple private jets and a bunch of Lambos, but typically you want to be thinking multi-generational money with your $50 million. So you want to think multi-generational, and you also want to think tax efficiency. The other part that you're going to have to consider here is the emotional aspect of this. So if this is family money, great. That's fantastic. Congrats. If you either sold a business or, you inherited or whatever it may be, congrats on the wealth, but you're going to have, issues because you're going to get people coming out of the woodwork. You're going to get friends. You're going to get, old high school buddies. You're going to get, people you play hockey with or whatever it may be that are going to come out and want to basically put out a hand and ask for some of your wealth. So you're going to have to be incredibly careful with that. By all means, if you want to be charitable to them, but we would suggest you do it in a tax efficient way. Now, the emotional aspect with respect to the family is one that we work with at a deep level. So it's important for us, if the money is family wealth, it's important for the family to have a conversation about what the future looks like with the wealth. Most likely, that's going to involve a trust or multiple trusts, family trusts of some sort, where the income can be generated, the income can be split, and probably backed with a trust deed that outlines when and how the individuals, the beneficiaries, the kids, the grandkids can draw down from that trust. Do you want your kids and your grandkids to be able to access that money when they're 18? Maybe, probably not, right? Do you want them to access it when they're 25 or 30? What if they really needed to buy a house? How are you going to structure this? Have you thought of how you're going to structure this to make sure that the wealth is used to help, but not hinder, right? We don't want the problems associated with the next generation falling into too much wealth. That's a serious issue. You lead down potential problems, and you don't want that, right? You want to make sure everyone's taken care of, and yet you want to make sure to have as much as possible a normal life. You've built this wealth, so you want to make sure that it's there to help the next generations if you do have kids. Now, philanthropy. What do we do with philanthropy? You got $50 million. Do you have expectations or do you have goals with respect to philanthropy, giving away some of that money? Do you want your name on a wing of a hospital or a university or a school? Is that important to you? Do you have community related aspirations that where you want some of that money to pay for something in the community, whether it's a tennis court or whether it's an outdoor hockey rink or whatever it may be? So I would consider, if I were you, all of those charitable aspirations, all those charitable aspects, and figure out how much of it you want to do. If you want to do a lot of it, an easy way to structure that is to set up a family foundation or a personal foundation, whereby in an extremely high taxable year, you would move a big chunk of your wealth into a family foundation. You immediately get the tax credit for all of that charitable contribution, and then you can then donate year in, year out to charitable organizations that you want. So the neat thing about that is, let's say you're in a year where you've made $50, you're paying a ton of tax, you want to reduce that tax bill, and you know long-term you want to donate to charity. You could take $1 million or $2 million or $5 million out of that, put it in a family foundation. You immediately get the entire discount on that charitable contribution today, and then you can choose to donate 3, 4, or 5% of that amount every year to the charity of your choice. So if you were to put 10 or 20 million in a family foundation, we're talking real numbers, right? If you put 20 million, you could donate $1 million every year to an organization or a charity of your choice. So this year, maybe you could give for the tennis courts, and maybe it means something to you to have your name on a tennis court, the local community club. All right. So now this year you've donated $1 million there and it's recognized. Then maybe next year you want to donate to the hospital and you want to get your name on a wing there. Maybe that means something to you. Maybe you want to donate to a school or a university, and you care about getting a legacy there as well. And if you don't care about a legacy, maybe you want to do it all anonymously, and you just want to make sure that the right organizations get the money, and you want the flexibility to donate it every single year. So that's one thing that we talk about and we take care of, is the charitable aspect. So we talked about the family aspect, setting up trust, protecting the lineage of money. That is something that you have to and must consider when you got $50 million. So we talked about the family aspects. We talk about the charitable aspects. Now, the last part is obviously taxation. We talked about it earlier in portfolio construction. So we talked about it earlier. Make sure you're protecting that capital. You want to make sure that you're not investing initially in fly-by-night stuff. Be careful. You've got all this money, all right? So now you got it and you're like, what do I do with it? Maybe you've had it for a while, but maybe you haven't. If you just get the $50 million today, I guarantee you're going to start getting calls from individuals who want you to invest. So are you going to invest in the club? Maybe it's a dance club that your buddy from high school, he just needs $1 million. You got 50. I just need $1 million to get this dance club going. Is that a good use of your funds? Maybe your other buddy or your cousin is, wants to start a golf course, or maybe he wants to start a real estate development project, and maybe they've got no experience. Are you going to trust $1 million with that project? What you need in my mind is a fiduciary. A fiduciary is the highest standard of care that exists at law for someone giving professional advice, for someone giving wealth advice. I know because I am a fiduciary. I was a fiduciary when I was a lawyer. I used to practice law and I used to give advice on the legal side. And that's why a lot of my background has translated so well to dealing with high net worth and ultra high net worth individuals, is because I've given advice on the legal side with respect to these things. And now that I'm a portfolio manager and I run a family wealth practice, we're giving advice on the wealth side. And every time I give advice, every single time, I have to and must act in the best interest of the client. That does not exist in a lot of other areas. You need to make sure the individual you're working with is a fiduciary, because they are going to give you the absolute best advice for not just your portfolio, but for everything surrounding your portfolio. And ideally, you're working with someone like myself who's got the law degree, who's got the finance MBA, who is a portfolio manager, who's seen a whole bunch of investments either go down or go up, and understands how that fits in for someone who's got a $50 million net worth and works with individuals, a whole bunch of them who do have $50 million of net worth. That's what we do here. So we'd love to work with you. If you have questions, by all means, go to www.speaktorob.com. We'd love to book a no obligation consultation for you to chat about this or anything else that's on your mind, please take a sec to subscribe to our YouTube channel. Please share. We'd love to hear your comments and look forward to seeing you in the next video. Thanks, guys. Have a great day.